panelists, I'd like to start by taking up the same question I posed to our audience in that poll. And we're going to get those results momentarily so everybody can see what answers we got. But I thought I would start with you, Marko, the man behind this concept of geopolitical alpha. Where does Latin America belong in a multipolar world?
Well, thank you so much, Erik, and thank you for Panama for hosting this event. This is incredible. I would say that the worst thing that Latin America can do is make a mistake that other countries are making right now, such as Australia, as an example. Not to pick on Australia, but to think that the world is becoming bipolar, that it's bifurcating into two zones, two spheres, China on one, maybe Russia, US on the other. I don't see that happening at all. Ukraine didn't change anything. Ukraine is simply a symptom. It's reinforcing a multipolar distribution of power. And in that world, it just makes sense for Latin America to be as promiscuous as it can be from Latin American interest perspective themselves and play every single side for whatever it can. Now, you'll talk to a lot of investors. You'll speak to a lot of investors who will say to you, well, you know what, we're going to divest from China. You know, we don't want to deal with that. We don't want to deal with the nuance of this geopolitical situation. It's easy for them. They have exposure of 3 to 4% of their assets to China. Latin America trades 40% of its exports with China, and it's not because 60 goes to America. So I think multipolarity is a great opportunity for Latin America to basically get advantages of playing every single side against each other.
I just want to underscore what Marko just said. He's urging Latin America to be promiscuous.
Yeah. Yes. Geopolitically.
That is
my expertise.
A provocative point of view.
Yeah.
Stanley.
Since you asked for a conversation, the only comment that I would make is that when you dance with elephants, you dance carefully.
Okay, now we have elephants in the
dragons,
bordello.
and bears. You know,
Are you saying, Stanley, that you share his point of view or you differ with his point of view?
No, I share it in the sense that I think you have to explore all your alternatives, but I think you have to do so carefully. I think too many times we rush into things on a macro level and don't really get down into the details, and you get killed in the details.
Okay, I'm looking at Shannon and Mauricio for some perspective here. Is the world rushing into things, as Stanley just said? Want to go first?
Sure, I guess I would add two things to this. And sure, I think keeping your options open is always a good idea. But when you look at the trade Latin America has, not all trade is equal. So there's quantity, but there's also quality. And I look back at the history of Latin America's economies. In the 1980s, 1990s, you saw its trade growing in value-added, more medium-skilled, more high-skilled, and that all really stopped in 2000, right when China came into the WTO. And so we've seen a huge explosion of trade with China, and that has been good. It's allowed economies to grow. It allowed poverty levels to fall, particularly in the beginning of this century. But it hasn't allowed Latin America to continue that climb up in its exports and even its production that is higher value-added, that provides better jobs, that provides a longer-term economic development path that you saw continue in Asia and continue in Eastern Europe. So, Latin America is one of the regions of the world that what economists call has suffered from premature deindustrialization. So manufacturing is shrinking even as the economy goes forward. And part of that is China. So I would say, yes, keep your options open, trade with China and the like, but China has been a double-edged sword for the region. And so as you look to change your economy, diversify it, make it more sophisticated, there are other actors around the world, and particularly the United States and Europe, where your trade may bring more for your people and more profits to your companies than before.
I'm going to press you on that point before Mauricio jumps in. Is the advice you're offering just to be careful, or is it to say you're better off choosing one over the other?
Well, I would say two things. One is you may be better off in some sectors in choosing one over the other. You may be better off not just sending out raw materials, but processing them in Latin America and sending out the processed goods. And the other thing I would say is Latin America may not have a choice, right? These two giants, the elephants, as Stanley just brought up, may force you to choose in some sectors, in some areas. So it may not be, you may not allowed to be as promiscuous as you might want to be.
Mauricio, does Latin America have a choice?
Look, so I'm always, as usual, I'm always the dissenter in the group, and I speak with frankness. And by the way, I say so with both the United States and China being members of the Inter-American Development Bank. But you know what? Make a choice, because here's the deal. We have a once-in-a-lifetime opportunity. And by the way, congratulations to Bloomberg, because you are in the right place at the right time, in the right country, and thank you to the leadership of President Cortizo for what we're seeing here in Panama as a leader of this opportunity. What's the opportunity? We have the two biggest realignments in supply chains in our lifetimes. What we're seeing today in the region, we're never going to see again. We saw the supply chains shut down in China, and then what we're seeing now with Russia's invasion of the Ukraine. This is a unique opportunity for Latin America and the Caribbean. Globalization as an experiment is going to stay. There is positives, but what we're going to see is the trend towards regionalization. And that's a win for Latin America and the Caribbean. Look, there was a McKinsey study just a couple of months ago that said 90% of CEOs, of US CEOs, said that they are looking towards a trend for regionalization. And this is something that we're not just talking about, and I always learn from Stanley. Stanley hates it when we just talk. We want to walk the walk. Since day one at the Inter-American Development Bank, we took nearshoring as a priority for the bank. And in that regards, we've done $4 billion since day one of nearshoring just last year, of which we saw $2 billion for governments to help them with logistics, $2 billion for companies to move their operations. There's not a day that goes by that we don't see companies call us asking, where can we invest in the region? And look, Mexico is always the easiest because obviously logistics, proximity, etc. But sometimes it's a little bit more complicated, and actually Shannon is the expert on that, of why it's more complicated. I'll defer to her on that. But how do then we get smaller countries? And look what Panama, Costa Rica, and Dominican Republic are doing. This is a great idea. We see this alliance for the development of democracies. Panama, Costa Rica, Dominican Republic, together, third largest exporter to the United States after Mexico and Brazil. We need to make sure that the small countries with the logistics get together, have the opportunity to break the integration obstacles that have happened for the last 50 years, and instead facilitate that commerce, and it's going to be groundbreaking. By the way, let me just say something in regards to China. They're a member of the bank, and over the last 10 years, the IDB made the wrong bet on China. Brought them in, was the fourth largest procurer of bank projects in the region, etc. And that was a mistake, because here's what we did over the last 2 years, which everybody said was impossible. We focused on selling the bank in the United States to U.S. institutional investors to take advantage of this realignment, and we broke all records last year in private sector mobilization. And guess what? Without a single Chinese yuan. It was all U.S. investors looking for this regionalization, looking for this realignment. So we need to double down on this opportunity, because the region wants U.S. investment, and the region wants also institutions that are going to mobilize it. That's why we did IDB Invest 2.0 as a mobilization arm. We're de-risking, we're originating, de-risking, selling portfolios, and guess what? Mostly to U.S. investors. We have to take this opportunity. The interest is there. It's not about political rhetoric. Remember, 20 years ago, I'm going to shut up now. 20 years ago, when you had like the 30 years ago, the free trade area of the Americas, the political rhetoric was about the region. But guess what? The investors were looking at China. For the first time in our lifetimes and ever, the political rhetoric and the corporate will are aligning. If we don't mobilize, if we don't incentivize it, it's never going to happen again. So we need to take advantage. So take it, choose a side, take the opportunity, and ram it through.
As usual, Mauricio doesn't really have anything to say here.
I'm not shy.
Mauricio, I do want you to continue, though, because nearshoring, a term you just used, is gaining currency. And I want you to explain, from your perspective, as an organization that is financing supply chain development in this region, why multinationals in the United States and Europe will choose nearshoring in Latin America over reshoring themselves, or diversifying away from China to other Southeast Asian nations.
Reshoring is not wholly practical. And look, I was obviously in the previous administration, and the previous administration was reshoring, and we lost an opportunity after COVID to really start focusing on nearshoring, and I lost that battle. You know, we had individuals in that administration that was all about reshoring, and I fought the fight, and then guess what? I got elected as president of the IDB, and within 1 month, we had a complete framework of all the comparative advantages. It's all about comparative advantages. It's like David Ricardo stuff. Comparative advantage, and there's advantages of each country in the region, and we mapped out the region with comparative advantages. We've done 16 nearshoring frameworks with countries in the region that we've done from the IDB, and we're matchmaking. We're taking those opportunities, and we're seeing it every day. So that opportunity is real. I think everybody now understands. By the way, even countries in the region. I remember when I was elected and I started talking about nearshoring, there was countries even from the region that said, hey, this is a geopolitical thing. This is not a geopolitical thing. I'm the president of the Inter-American Development Bank. My job is to bring jobs, development, and opportunities to my 26 borrowing nations. Every time there's an investment that goes to China, that's a lost opportunity, that's a lost job, that's lost development for Latin America and the Caribbean. So my job is to highlight the comparative advantages of the region and to move those investments there. And guess what? We're the only institution in the world that's also financing them. We did for the private sector alone $2 billion moving those in, and countries every day are coming asking us because it's real, because they saw the supply chains shut down. Hey look, let me give you just a quick anecdote. In regards to ventilators before the vaccine, and I lived this in the US government, when the supply chain for the ventilators, it was done on the National Production Act, the Domestic Production Act, Defense Production Act, in order to get the ventilators moving, getting into the countries. And guess what? Suddenly there was one small part of the ventilators that went essentially awry, and all the ventilator production stopped. You know where that little screw was made? In St. Kitts and Nevis. And then St. Kitts and Nevis, that little island, was key to the ventilator production. And then we got it going because it was St. Kitts and Nevis, because in China, all of them had shut down. That same factory in India had also shut down. So thanks to St. Kitts and Nevis, we had ventilators. Thanks to Mexico, we continued the supply chains during the worst days of the pandemic early on in 2020. So what the region learned, what the world learned, what companies learned, what everybody learned is that you can rely on Latin America and the Caribbean. This is not only good economic sense, this is good for national security, this is good for integration. It's a win-win across the board that we have to take advantage of.
Well, I'm glad Mauricio has a lot of energy, because let me tell you, he's going to need it. And he's going to need it because if you look at the actual data, none of that has happened. And what I mean by that is that the only country that grabbed global share of exports over the last 2 years, guess which country that is? It's China. And it went straight up. So over the course of the pandemic, if you look at exports as percent of total global exports, we haven't nearshored or reshored one bit. The reality is that China has become more central to the global economy. Now, I do think that's going to unravel. Like, it's unsustainable. There's obviously push to do that, and obviously Mauricio is pointing out how Latin America is dealing with it. Other countries are as well. But that's the important point that I'm trying to emphasize. Other countries are trying to do this as well. Everybody's doing it. India's trying to do it. I mean, they have a huge push. None of it has happened. All the FDI has gone to services because of premature deindustrialization, which is most actually felt in India. But Europe is doing the same, putting up protectionism as well. And that's my point. I'm still hearing on this panel the same thing you can read in every op-ed, in every single very cheap newspaper you can pick up. China, US, China, US, China, US. Forget it. It's not China, US. The world is late 19th century, early 20th century. It's a multipolar world. You have to deal with many, many different countries, and you have to deal with them with a strategy, not just having a view that you have to pick America or China, because those days are over. And I think our biggest problem is history. We're constantly anchoring ourselves to this lullaby, this like fairy tale we tell our kids, which is the Cold War. Cold War, it was a simple world, bipolar. If you're an asset manager, you have an Excel spreadsheet. Here's where I invest, here's where I don't invest. If you're running a country, like good country, bad country, forget it. Forget it. Read books about the 19th century. We're in a multipolar world, very messy. You have to have a strategy for every single country, every single trade bloc. And that's really exciting, I think, for a place like Latin America, because you don't have to pick sides. Don't pick sides. Forget about that. Wait. Let's see where the world goes in the 5 years.
Let me chime in and just in the spirit of Mauricio to dissent, and maybe because I write for one of those cheap newspapers. Well, not so cheap, because I actually write for Bloomberg. So
Definitely not a cheap newspaper.
No, definitely not cheap. Okay.
It comes with a screen.
So what I see is different now. It has a little bit to do with the late 19th century, early 20th century, but different is the return of industrial policy, right? And this is something that, whether at least rhetorically was not part of the global consensus for the last 20, 30 years, even if some countries were still doing it. But now you are seeing numerous countries, many countries, almost all countries, and particularly the United States, change just not rhetorically, but also substantively. And this, I think, it's no longer going to be just markets. It will also be what governments decide. Just a piece of data to throw out there. Over the last 15 years, we've seen almost 20,000 subsidies, domestic subsidies put in place by Europe, China, and the United States. And it's all pretty even. All of them are putting in similar numbers. So we're seeing so much intervention economies by governments for a whole host of reasons. Some economic, some public health, some economic competitiveness, some national security reasons that are broadly defined. This is a fundamental game changer. And there, I do think, it won't be every sector, But I do think we are going to start seeing dividing up. We're going to start seeing governments, particularly government procurement and particular sectors they intervene in, wanting to bring products in from places that they quote unquote trust. And this is an opportunity for Latin America, frankly. Both we're seeing markets change because of automation, because of demographic changes, because of the logistics hiccups we've seen over the last 2 years. Places that are closer to the United States, if you're serving the US economy, will matter. But we're also seeing it for these other reasons. In Latin America, the United States has very few free trade agreements on the world. It has preferential access to less than 10% of the world's GDP. But the agreements it does have, most of them are in Latin America. So you have preferred access. The economies here, the companies that are based here, have preferred access to what is still the largest consumer economy in the world. So I think there is a benefit here, and I don't see industrial policy ending anytime soon. We can have a discussion about whether it's good or bad or ugly. That's not the point. I don't see it ending anytime soon. So that is going to be the shape of the market. The markets will be shaped by governments for the next decade.
Regardless if you choose size, I look at the other side of the coin. Are we ready to onboard what wants to come to us? And that's the other side of the coin. I always remember many years ago, a friend of my father's who was an American, had a construction company, was in his office, and he said, Stanley, I finally learned the definition of mañana. And he says, what's that? He says, for sure it's not going to be today. So the reason I say that is if we want to do these things, we have to be prepared to onboard. We have to simplify the processes. We have to really be able to land the deal, if you want, and allow the companies to furnish. Some countries do it better than others. All of us can improve it.
Stanley, explain a little bit more what you mean by onboarding.
Well, onboarding is when you're saying people want nearshoring. A company comes to a country and wants to do something. What do you do?
You're talking about immigration policy, red tape.
Immigration policies, tax policies, et cetera, et cetera. And even the tax policy is going to change with the 15% minimum tax the world wants to implement. So all these things need to be put together, and you need to have one place to go to solve your problems. And that person has to have certain seniority to get things done. One of the things, I mean, it's debated here in Panama. We have a lot of foreign officers up here, but one of the problems we have is we're going to have to allow the spouses to work. This is a new world. Both work. In a way, they're going around it because some of them are working remotely. But when you move to a country or you tell an executive to move, he says, what about my spouse? Is he allowed to work also, or is she allowed to work? So those type of, that's only one little detail of a lot of things that you need to fix. Schooling, there's a bunch of stuff that goes with this. So it's a little bit more complicated. So what I meant by onboarding is the country has to be prepared to deal with these requirements.
Can I thread? I think we're coming to the common thread here, and also just to kind of simplify something so we don't mix apples and oranges. There's trade, and look, absolutely, China is a market and has a large domestic market. And if you have a product that you want to export to China, absolutely, export it. Like, we're not saying don't sell to China. Like, of course we want to sell to China. That's important. But then we're talking about foreign direct investment. And at the end of the day, the whole panorama changes. And while China is an important trade partner for Latin America and the Caribbean, it's the third largest investor in Latin America and the Caribbean. The United States, by far, is the largest investor in Latin America and the Caribbean with almost $1 trillion. And by the way, there's been a correlation. As U.S. companies look more towards China, you saw their investments in the region decrease. So there's a correlation that we're trying to bring back in that regard. And then the second is Spain. So actually, Spain is a larger investor in Latin America and the Caribbean than China in that regard. But here's where the thread is. Is it happening? Absolutely. Like, there's not a day that we don't get calls. I got, like, one of the biggest apparel companies in the world literally just called me 2 weeks ago, said, hey, we have $5 billion in outsourcing that we currently do in China that we want to bring to Latin America and the Caribbean. Where can we do it? And then it goes to Stanley's point. That's the challenge. The challenge then is, how do you create the capacity? Does the region have the capacity to do so? By the way, let's look at the renewable energy space. Huge opportunity. And I was just talking to Mariano Rivera and the team that they just announced this exciting project here, and congratulations against the Panama on renewable energies in that regards. Hey, look, every product, every natural resource for electric batteries, for windmills, et cetera, it's lithium, copper, et cetera, 60, 80% of it right here in Latin America and the Caribbean. Well, what happens? It's exported to China, processed in China, and then exported to the United States. We need to break that east-west supply chain. Clearly, COVID taught us is not efficient. We need to make it a north-south supply chain. Is it going to happen overnight? Are you going to see, that numbers? No, because of a capacity issue, which is what Stanley brings together. So, is the will there? Is the opportunity there? And by the way, we see it in that space. There's $25 trillion in ESG investments, and we're helping mobilize as much of that as possible, and here in the region. If we had $1 trillion of that here in the region, that would be game-changing. But guess what? We see the pipeline. We at the IDB, we have a $300 billion pipeline right now for all Latin America and the Caribbean on energy projects. So even if there were $1 trillion that wanted to be invested here, which is what we're trying to push and mobilize with IDB Invest 2.0, et cetera, we only have a $300 billion pipeline. We need to originate more projects in that space. So it's happening. Absolutely it's happening. We need to land the plane, though, and there are some regions.
Mauricio, I can't help but put you on the spot.
Yeah, not afraid.
This apparel company called you and said, we have, what was it, $5 million of...
$5 billion.
$5 billion to move out of China and into, what did you tell them?
Told them, let me help you matchmake. And then I start calling and I start looking for great countries that have the capacity, that have already the textiles, that at the end of the day, here's another issue we have with the United States. The United States needs to take advantage of this opportunity, but I don't want to just dig it into textiles. But in textiles, there's another problem. CAFTA DR is antiquated. CAFTA DR is actually an impediment for textile exports to the United States because the North Carolina lobby said, oh, you can only have 25 thread lines out of the 150. So guess what? All you can export from Central America is t-shirts and underwear. And meanwhile, all the higher end goods get brought in from Vietnam and China because it's less expensive. That goes then to the infrastructure, to the regulatory, to the transportation costs. By the way, if we were just able to bring down transportation costs, it's almost illogical that to transport from Latin America and the Caribbean is 60% more expensive to the United States than from Asia. So there's a lot of work to do, but guess what? It's at the micro level. So that we can get to that macro statistic that Marko loves on the global trade, we need to work at the micro level, and that's what we're doing. We're rolling up our sleeves, hustling every day, working with great teams like here in Panama, finding those opportunities, matchmaking, and making them happen so that we can have the macro impact.
I've kind of heard all I need to hear, and let me say why. You guys are in a very good spot. You're in the front row, okay? Panama. Because you've got basically, half of this panel is basically USA. I see the U.S. embassy guys, very subtle, they're out there in the fourth row. They're not in the first row anymore. You see that? They're in the fourth row. You've got, choose sides, choose America. What I'm trying to say is this is why I'm so bullish Latin America. What's happening is no one's telling you what to do, unlike in the 60s, unlike in the 70s, unlike in the 80s. No one's telling you what to do. They're saying, choose this, choose that. That's beautiful. And my point is why would you choose? Don't choose. Wait as long as you can and see who gives you the highest price. That's my point. And that's why as an investor in liquid instruments, so I'm in the public markets, what I want to do is I want to have an anchor in Latin America. You've got the demographics, you've got a commodity super cycle, which will give the trade advantages. You have financial technology that's allowing people in Latin America to access financing they haven't had before. There's so many trends that are bullish in Latin America, and geopolitics is one of them, precisely because it's not the 60s, 70s, and 80s.
Can I just agree, because we've disagreed on everything, but I do want to agree with Marko that if you're going to invest in Panama. There, I agree. I think it's a great place. So I always like to find, just so that people don't say I'm always, looking to the villain. I do agree with Marko on that. Panama.
There we go. Nobody can accuse this panel of failing to achieve consensus on something.
Leave money here.
Ladies and gentlemen, I'd like you to get out your phones again because I have another polling question for you. And in some ways it takes us back to the original question for this panel. Which is the more, there we are, yes. So I'm sorry, I'm just seeing the polling results from our first poll, which I had not seen before. And overwhelmingly, the audience, I'm sure you may have seen, shows that that Latin America should pivot back, if you will, to the United States and Europe. But here's our second polling question. Which is the more relevant lesson from Western sanctions on Russia? Despite its flaws, the dollar-based financial system is still better than any foreseeable alternative, or the dollar has been weaponized and governments should embrace rival currencies as a hedge against U.S. interventionism. Ladies and gentlemen, please enter your responses, and we'll see the results shortly. And as we await those results, I'll put this question to our panel. Does any company or government doing business with China now have to consider Taiwan as a potential Ukraine? Shannon.
Which of those questions? Both of those questions.
Well, no, the Taiwan-Ukraine question, and we're going to wait for the results
okay.
here, and then we can take that up as well.
I think China is thinking about Taiwan as perhaps the next Ukraine. So, right, they're doing models on what would happen if similar types of sanctions were put on China down the road, right? If they were cut out of SWIFT, if their central bank reserves that were in other places than China were cut off from access. So there's definitely one big country thinking about this issue, and so I think everyone needs to think about this issue. What we have seen from the US and I think also from Europe increasingly, and one of the, to me, most striking things of the last 4 or 5 months is the unity that we saw between the EU and the United States. I don't think anyone would have predicted that on New Year's Day at the beginning of this year, that we would see such lockstep between those two big, geopolitical but also economic powers. And China's a bit more complicated because trade matters a lot more, at least for the United States. Europe, obviously, Russia matters significantly. But I do think that unity, as we look in the next couple of years at least, is going to stay there. And so, yes, I think China needs to think about, China will be thinking about Taiwan, and I think Latin America, other places need to think too.
Well, that unity between the United States and Europe on the subject of Russia is certainly something I would imagine people had in the backs of their minds as they answered that polling question. Let's see the results. There we go. As you can all see, an overwhelming endorsement by the audience for the US dollar as opposed to some alternative. Marko, what do you think of that?
Oh, 100%. I mean, there is no, you yourself, the way you say, some alternative. What alternative? Bitcoin? Ha! How's that working out? No, listen, I think that's an easy question. What we saw in the 19th century is the pound went from 64% of currency reserves to 49 in like 30 years. So that's not going to change. But one thing I will say where I disagree with Shannon, Taiwan question, agree. I think Europe is going to take a cold shower in 6 months. Be very careful about projecting forward the favorite kind of op-ed theme, which is transatlanticism is back. Europe will take a cold shower in 6 months.
A literal cold shower.
Literally, probably, because they don't have natural gas, yes. But the point is that when they do, they're going to say, hold on a second. We had a way of dealing with Ukraine, which was the Minsk Protocol, which the Ukrainians didn't want, but too bad, we did. It worked. And then Americans showed up, and we're like, you don't have to sign that. We've got a better idea. You're going to be in NATO. And Europeans were like, yeah, sure, maybe, My point is, America has a different risk tolerance level than Europe does when it comes to dealing with Russia, for obvious reasons. How many refugees did the United States of America accept in March? I'll tell you, 16. How many did Europe have to deal with? Millions. So Europe is going to take a cold shower in 6 months, and this transatlantic thing is like a flavor of the month. It's going to last 6, 12 months. Think about it. If Germany rearms, it's not going to acquire tanks and aircraft. It's going to acquire an opinion. That's what military capability gives you. It gives you the ability to back up your interests. So again, don't double down on what's the flavor of the month, which is bifurcation, bipolarity. The world will get even more complex and even more multipolar because of what happened with Ukraine.
If I may real quick, and just because I have a kind of unique perspective in that we have at the IDB 48 shareholders. So we have obviously the countries in the region, the United States, Canada, the European countries, and Japan, China, Korea. When I began on October 1st, 2020, and I actually started doing nearshoring, the European countries were critical. Were critical because they said, the IDB is not an investment promotion agency. And I said, well, it kind of is, because that creates jobs, development, et cetera. But then also they're like, it's too geopolitical. Today, we're seeing a transformation. I agree with both. We're seeing a transformation in Europe. Today, they tell me, hey, Mauricio, we were a little oversensitive with this nearshoring thing before. you know, we get it because we want to nearshore now as well. And what Ukraine has done is that actually has created from a different perspective in regards to the commodity trade in that regards too. In regards to Taiwan, something really interesting. Taiwan is also nearshoring, you know, in that regards. And, you know, they too, like I talk to them all the time about their semiconductor industry. They want to invest more in Latin America and the Caribbean in semiconductor production here in Latin America and the Caribbean as well. And one last thing on the dollar. I'm just doing the quick shot. Hey, look, there's the advantage of it is look here in Panama. I mean, inflation is a global issue, but the good thing, the part of the good news and all the bad news is that Panama's been least affected because of their dollarized economy in that regards. And there, what we can do and what we do together with the government is then focusing on the vulnerable populations, how we can help them directly with the price, you know, obviously rice, beans, chicken, etc. But the impact that we're seeing in other countries throughout the world, we're seeing less so in countries like Panama, Ecuador, or other dollarized economies.
I asked the question to the audience about whether the US dollar has been weaponized or not and what is preferable among those two alternatives. Weapon or not, Stanley, the dollar is surging. I'm sure you've noticed. By some measures, in fact, the dollar has not been this strong since the early 2000s. And of course, inflation is accelerating on a global basis. Sri Lanka, yes, it's halfway around the world, but Sri Lanka is about to default on its dollar-denominated debt. Stanley, you and I were talking about this. Many Latin American countries increased their debt loads during the pandemic. Do you think they now face the same fate as Sri Lanka?
No, I think it's different. You know, just quickly, everybody's looking at the similarities between Russia and Ukraine, China. I look at the differences. And I think, just to finish with that point, that there's a lot of differences between the two. If China attacks Taiwan, what do they get? Maybe a totally destroyed island, and that's the end of it. So I'm not sure that I think they have a little bit more thought behind it. But going back to your question, look, a medium of exchange is something people have to accept. Now, the United States has been very fortunate. I keep repeating that the world has $1 trillion lent to the United States at 0 interest rates. And everybody says to me, what's that? I said, that's the amount of US currency floating around the world that is never coming back. And why is it there? It's because they don't accept the euro in the same fashion. They don't accept any other currency in the same fashion. So it's a matter of acceptance. It's not really a matter of whether it's being imposed on you. You have little alternative to store value. And that's what people have used for, you know, I guess at least 100 years. So I don't see it as a weapon. I just see it as a reality, and you have to deal with that reality.
Well, the reality now, of course, is that the dollar is very expensive. It gets increasingly expensive in local currency terms to service your dollar-denominated debt.
Well, I mean, it kind of depends. I think country by country. Commodity importers like Sri Lanka are going to have a problem. I mean, that's what's really at the heart of what's going on in Sri Lanka. Commodity prices have surged. But I think that the dollar surging is actually, there is a benefit. And the benefit is that it's going to help tame inflation in the US. Because the much bigger problem for countries like Panama or any other country in the world is that the Fed is now laser focused on fighting inflation. Again, that's the economist's cover. Like, let's just go 6 months ahead of time. I think in 6 months, this hashtag inflation hysteria will become hashtag recession. And what's good is that I think that inflation is probably going to peak. It's not going to come down below 2% for a decade. Don't get me wrong. Like, if you're invested in bonds, take what I just said to heart. But the point is that it's probably peaking. And over the next couple of months, the Fed is going to be able to step off the accelerator a little bit, which is very positive for countries in emerging markets. Because right now, everyone thinks the only path of interest rates is higher, much faster. I think dollar strength is the first pillar of that being eased. The second is the fact that China has decided to like double and triple down on this COVID-19 policy, which is going to wash the world in disinflation.
Stanley.
Quickly, 2 things. If you look forward, what should we worry about? Me, I think you have to be careful what imports you're going to need and are you going to be able to get them. And the second thing is countries are not going to have easy markets. We went into COVID with easy markets. Most of the countries were able to borrow. Yes, the percentage of debt has gone up, but it's gone up because the GDP went down and the amount of debt went up, so the percentages are a bit exaggerated. But the real problem going forward, to me, is you're going to have to worry about what you import. Are you going to be able to get it? And I don't think there's going to be that easy money out there. For sure, it will be more expensive, but I'm not even sure you can get it.
But before we are forced to wrap up this fabulous conversation, I want to mention that Juan Sebastian Gonzalez, the special assistant to President Biden, he holds the job that Mauricio had in the Trump administration. He is the senior director for Western Hemisphere Affairs on the National Security Council. He ought to be able to tell us a little bit about the thinking inside the White House, but I'm going to use that as the preamble to this question from our audience. Thank you to whomever submitted this. Will the United States allow Latin American countries to choose their economic alignment, or will those countries be forced or influenced by sanctions to choose the United States? Shannon.
Here I agree with Marko. I don't think we're going to force anyone to choose anything. I think it's going to be really hard to trade with Russia right now, though Latin America doesn't trade with Russia. There will be other places around the world, perhaps, that the United States, Europe, and others will have sanctions on. That, too, will limit markets. But I don't see it a proactive, punitive measures on Latin America if they want to trade with countries that are not sanctioned around the world.
Mauricio.
So look, I've been there. I've been here. I know what tools the U.S. government has. I know what tools it doesn't have. Forget about it. Forget about governments. Get your mind off governments. Focus on the private sector. It's the private sector that's going to create growth. It's the private sector that's going to invest. And there's no greater private sector in the world than the U.S. private sector in that regards. And what we have to do, what we have to focus on is incentivizing. And that's why we've been focusing. We came into the bank. We created this new model. We're going to mobilize that private sector investment. We're facing trillion-dollar problems in the world, and our IFIs have billion-dollar budgets. We can't deal with that. Only the private sector can do it. But here's the opportunity. And I'm going to close on a positive note for Latin America and the Caribbean. Look at the indicators. For the first time in history, MSCI, you're seeing emerging markets in China, elsewhere, all going down, and Latin America is actually going up. There's actually moving apart. That's never happened before. You've never seen China go down and Latin America go up. It's never, ever happened before. Look at bond spreads. I mean, just look at the MB. You're seeing, particularly after the war in the Ukraine, everyone's gone down, and I mean, everyone's gone up, but guess what? Latin America and the Caribbean, with the exception of Argentina, Bolivia, and El Salvador, has actually gone down. So investors, institutional investors, are recalibrating what had been, in my opinion, an over-prejudice on political risk in Latin America and the Caribbean, because guess what? Compared to the rest of the world, it's like a lake of peace and prosperity, and it's a huge opportunity, and what we have to do is mobilize and incentivize as much as possible. And look, the U.S. government, I wish it had all of the tools necessary to incentivize it and mobilize it. It does not. No government does, except China. If you own the private sector, right? Then you can, you write the check, but that's not fair. We don't play by those rules in the United States. We have a private sector that makes its own decisions, so we have to mobilize it with good policies, and the governments then have to make good policies to incentivize those investments, as Stanley was saying. That's the magic formula. That's where it's at. It's a private sector solution. It's governments taking the right policies to incentivize it, and institutions like ours focusing on private sector mobilization. That's the solution.